Imagine building a multiplex with just 5% down. Sounds too good to be true, right? Well, thanks for CMHC's innovative financing program, it's not only possible, it's a game changer for high net worth investors. Let's break it down. The CMHC program offers an incredible opportunity. Only 5% down to finance multiplex construction. For savvy investors, that means stretching your capital and making your money work harder. Maximizing leverage is the name of the game here. With a smaller upfront investment, you can finance larger projects, spread your risk, and create scalable growth, all without draining your liquidity. Who qualifies? The program is designed for investors ready to build properties with 5 units or more. Multiplexes that cater to residential needs are prime focus, ideal for those looking to expand their portfolios while meeting growing housing demand. And this could work also for affordable housing as well as retirement homes. There are some aspects of student housing that also could benefit from this program. Now, the actual program is called CMHC MLA Select, and that's based on the point system. So either you will get points based on energy efficiency or affordability or accessibility. Let's talk about financing structure. Pairing the CMHC 5% down with creative strategies like joint ventures or mezzanine financing can unlock even more opportunities, giving you greater flexibility to navigate larger deals. Of course, with low down payment strategies, risk management is key. The good news? Using leverage wisely can help you mitigate risks, especially when you have a strong cash flow plan and a solid exit strategy in place. Don't just take my word for it. Case studies show that high net worth investors are already using this strategy to rapidly grow their portfolios, turning modest down payment into multi-million-dollar assets. So if you're ready to scale up, tap into the CMHC MLA Select up to 5% down payment and start building the future of your real estate empire. Now it's the time. Let's make your capital grow further. Got questions? Reach out and let's explore how you can leverage this program to build smarter, faster, and bigger. As attractive as this program is, there are strategies that you need to implement right from the beginning of your construction, even prior to starting the construction, to make sure that your project qualifies. One of those is making sure that the units are 5% or more. CMHC does not get involved with anything less than 5 units. Also, you need to make sure that the building is energy efficient, and that needs to happen right from the beginning of your planning and possibly before you actually even purchase the lot, because not all new lots could be converted to 5 units. Even though you have a laneway, you may not be able to get a qualification that is needed for a laneway suite to go up, because there are restrictions on laneways. So not all laneways qualify for CMHC MLA Select or even to be constructed as a laneway suite. Keep in mind, in order to maximize your leverage, there are certain steps that you need to do to make sure that the rent that the property will provide will give you the appraisal value that you need to be able to put as little as possible after covering your costs of the lot and the construction. So there is more to it than just the 5%. We'll be happy to jump on a call to see if your plan will be viable and how much you actually need net to put in down the road. Now, the key player in here is the lot value. If your lot value is superbly high, if the restrictions on your lot, it eliminates your opportunity for a laneway or garden suite, or if the height for construction of the fourplex at the front does not allow an actual fourplex, then CMHC MLA Select will be out the door. So make sure that you will go through the proper due diligence to make sure that your project is feasible, if financially it's supported, and at the end of the day, the money that you invest, you're able to pull out and just leave the minimum amount in. In addition to 5% down, you get to have your amortization at 40 or 50 years, depending on your qualification, which is substantially longer than your typical 25-year amortization. So that brings your monthly payment lower, so it will leave more money on the residual income from your project. For example, a case study, a property in Danforth. Original purchase price, $1.4 million. Construction cost is sitting at $1.5 million. It will bring your total cost of construction to $2.9 million. Projected revenue is $225,600 per year. And based on that revenue, the appraised value will be sitting at $4.5 million. Now, from $4.5 million to $2.9 million, you made yourself $1.6 million. But now, considering that you could put in, let's say worst case scenario, putting 15% down. So you will take that 15% out, the rest of it you will have mortgage attached to it. That amount comes up to $3.8 million mortgage. Now, not only that amount of the mortgage will be serviced with the revenue that you have generated from the units, but also your original down payment has already been withdrawn also from the property. So you've left with $670,000 almost of investment in the property. That gives you seed money for your next project.